This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by...
Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus service is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
As goes January, so goes the year, or so goes the folk wisdom. And 3 weeks in, stocks have been down more than they've been up, leading investors to wonder whether there's more selling ahead.
Unwanted delivery, UPS warns, but why is the world's largest package shipping company blaming a demand surge for weaker profits?
And Market Monitor, our guest tonight, says he's investing in a blue chip, a value stock, and a cutting-edge tech company. We have all that and more tonight on Nightly Business Report for Friday, January 17th.
Good evening, everyone, and welcome. Stocks continued their somewhat tentative start to 2014 today. It was, as has been the case quite often this year, a classic mixed market. The Dow was the only one of the three major barometers we highlight to end the session with a gain, and that mostly because of positive showings in four of its higher-priced constituents: American Express, Visa, Goldman Sachs, and IBM. Only 8 of the Dow 30 were up today, but that was enough to power the index to its first weekly gain of the year. But don't get giddy. It was only about 0.1%. And so far in 2014, the Dow is off about 0.75%, and the S&P down about 0.5 point. Today's soggy trading was marked by worries over earnings and outlooks. For GE, the concern was manufacturing margins. For Intel, revenue forecast. For UPS, flat-out profit warning. On this Friday, heading into a 3-day weekend, the Dow gained 41 points. The Nasdaq today down by 21, and the S&P lost 7.
Let's turn now to Chris Gaffney for his analysis. He's senior market strategist with Everbank. So, Chris, you heard at the top of the program, the saying on Wall Street is as goes January, so goes the year. So should investors be bracing themselves for a down year?
I don't think so. We certainly have had a bit of a rocky start to the year, but it's been a short time period so far, and I think there's a lot of things that will support the market going forward, namely lower interest rates and I think increased consumer confidence.
I was speaking, Chris, earlier this week to a portfolio manager who said, well, we had a market that was up about 30% last year on earnings gains of about 6%. You do the math. This gives me the sense that maybe the market is getting very close to fully valued. What do you think?
We are, I think, more fairly valued right now, maybe slightly overvalued, but it's going to be all about earnings in 2014. I think, Tyler, it's definitely going to be dependent on companies having earnings catch up with those price earnings multiples.
They say on Wall Street that it's all about expectations, and we've gotten a lot of warnings this week, or guidance that's weaker than expected. Should investors just ignore this information? I mean, what are you saying?
Well, you certainly shouldn't ignore it, but I think it's become almost commonplace for companies to give some guidance as far as negative guidance, and then earnings have traditionally been better than expected. Now, we have some people on the desk that always say, the key to happiness is reduced expectations. So perhaps that gives here.
6 of the 10 S&P 500 sectors so far this year are actually in negative territory. But obviously, we've been trading for, 2.5 weeks, and that's not really much of a record to go on. But what sectors do you think will be the most positive contributors to market performance this year, and which will subtract the most?
Well, I think the financial sector obviously is already showing that it's going to be one of the better contributors to the markets going forward in 2014. On the negative side, I think the tech sector, as we've seen already again, we've seen kind of a microcosm of what I think we'll see going forward. Some of the tech sector is certainly going to be a drag.
So, Chris, we have more earnings coming up. Obviously, there's going to be some important economic numbers coming out over the next couple of days. And, what are you looking for? I mean, what are sort of the signposts that are going to guide you in your investment strategy?
Well, again, it's going to be all about the earnings. And again, I think that, we've got a holiday shortened week next week. The jobs numbers, the weekly jobs data, which has been a bit volatile, we'll get on Thursday, and then the housing numbers at the end of the week. Housing is a key barometer for the U.S. economy, and if the housing can continue to do well, I think that trickles over to consumer spending and consumer confidence, and I think that is what's going to drive the market higher.
All right. Well, thank you so much. Have a great weekend.
Well, thank you.
Chris Gaffney, Senior Market Strategist with Everbank.
More now on those troubles at the shipping giant UPS, which delivered some bad news to shareholders today about its earnings outlook for the latest quarter. That despite a record number of shipments. Morgan Brennan has more.
Investors getting an unexpected and unwelcomed delivery from UPS. The shipping giant warning that when it reports earnings at the end of this month, its fourth quarter profit will be smaller than expected. It's also forecasting full year 2013 guidance below the street's expectations. UPS blaming the outlook on an unprecedented level of online shopping that caught the company off guard, particularly a surge in last-minute orders as online retailers like Amazon extended offers. Analysts say the resulting strain on its systems forced it to spend more money.
Operating expenses in terms of extra overtime and in terms of significantly larger temporary employment pool than the company normally would use, to the tune of 30,000 more than they were expecting for temporary headcount.
The season's biggest delivery day came 6 days later than the company expected, and it was bigger, representing a 13% increase from 2012's busiest day. That, coupled with bad weather and a holiday shopping season that was almost a week shorter than last year, meant some packages didn't arrive in time for Christmas, causing the company to refund shipping costs for many customers. While today's news certainly wasn't welcome for investors, analysts do see a silver lining, saying last holiday season's hiccup could actually lead to a long-term growth opportunity.
I think this actually bodes well for UPS because what it does is it validates and maybe even amplifies our expectations for continued online fulfillment that benefits all of the integrated shippers like UPS and FedEx, and in Europe, DHL and TNT.
Still, the shift in consumer behavior is likely to result in more logistical planning and higher operational expenses for holiday seasons in the future. But for a company like UPS, which has enjoyed good cash flow and revenue growth, analysts say the extra costs should not be hard to absorb. In fact, despite today's lowered guidance, the shipper still expects to see as much as 15% growth in 2014. For Nightly Business Report, I'm Morgan Brennan.
Intel is slashing jobs. 5% of its global workforce, 5,000 workers, will get pink slips. The announcement comes just one day after Intel reported disappointing quarterly earnings and a lukewarm revenue forecast. Intel says it's shifting away from making computer chips, given weak demand for personal computers, and it plans to focus on faster-growing areas like servers.
Well, despite that, there is some good news today about the job market overall. In its latest survey on job openings and turnover, the Labor Department says advertised jobs rose to 4 million in November. That's the most in 5.5 years. And the number of people who quit their jobs that month, presumably to take on a better one, was the highest in 5 years.
An update now on that massive security breach at Target. A cybersecurity firm called Intercrawler says it's uncovered 6 active attacks on other U.S. retailers. It says the credit card processing systems at those companies are infected with the exact same type of malware that was used to access at least 40 million debit and credit cards at Target stores.
Meantime, we're learning more about the cyber attack on luxury retailer Neiman Marcus. The New York Times reports now that the online theft of payment cards and customer data at the upscale chain may have begun as far back as July and wasn't fully contained until just this past week.
In Washington today, President Obama announced some big changes at the nation's top spy agency while simultaneously defending some of its controversial surveillance programs. The president compared the National Security Agency's electronic eavesdropping into our private lives to what some companies are already doing to find out who their customers are.
The challenges to our privacy do not come from government alone. Corporations of all shapes and sizes track what you buy, store and analyze our data, and use it for commercial purposes. That's how those targeted ads pop up on your computer and your smartphone periodically. But all of us understand that the standards for government surveillance must be higher.
Well, those higher standards involve changes about who the NSA will no longer spy on and about storing all that internet, phone, and email data. Eamon Javers joins us now from Washington with more on President Obama's proposals. Eamon, there's a lot to talk about, but let me just start off with, many telecom and tech firms were really upset and very critical of the reports of previously unknown surveillance. How is that going to change with these new proposals, or will it?
Well, it's not clear that anything is going to change here at all. Both Google and Yahoo put out statements today. Interestingly, they were identical word for word, calling this a positive development, praising the president today for at least getting the ball rolling here on intelligence reforms. But what we don't know here is what is actually going to happen at the end of this. The president called for the Attorney General and the Director of National Intelligence to get back with him on some ideas about what to do with all this telephony metadata, and he asked them to do it by March 28th.
So, Eamon, as I gather, the government is no longer going to collect and store and analyze this telephone metadata, megadata, if you will. But who is going to store that stuff? Are the telecom firms going to have to hold on to all those records in case at some point the government wants access to them?
Yeah, Tyler, that is the big question here. It's a real hot potato. The president says he doesn't think the government should be in the business of collecting and storing all that data itself. But the question is, who is going to do it? That has been unanswered as of this point right now. The telecom companies have been resisting it. They don't want to hold it either. So it's become a bit of a hot potato. Another proposal out there is to create an independent third-party entity of some kind that would be brand new, that would be in charge of holding all that data. But there's no indication that that would be feasible either. And of course, if such a repository was created, you can imagine it would be a huge target for hackers and intelligence services around the world. So the question is whether that would create more problems than it solves here. So some real unknowns here going forward. The president says he wants to get out of this business, but where this business is going is anybody's guess as of right now.
Okay, thanks a lot, Eamon. Eamon Javers reporting from Washington.
And still ahead, flying high, airlines start reporting their earnings next week, and some say the results could be among the best the industry has ever seen. Today was a big day for Apple. The iPhone finally went on sale at China mobile stores today. So will Chinese customers pay more just to have an iPhone? And will Apple stockholders see any benefit? Eunice Yoon has the story for us tonight from Beijing.
With fanfare and phones, the chiefs of two tech titans celebrate their newfound friendship. Apple's Tim Cook and the chairman of the world's biggest cell phone carrier, China Mobile, are at this Beijing store, handing out autographed iPhones to some of the first to buy one through China Mobile.
Today we're bringing the best smartphone to the fastest network and the largest network in the world.
For 6 years, the two have been courting each other, unable to see eye to eye on commercial terms and technology. But now they've overcome those hurdles.
This is what the fuss is all about, an iPhone that can tap into China Mobile's high-speed 4G network.
China Mobile can earn more as customers spend on data. Apple could potentially sell millions more gadgets to the Chinese company's 760 million subscribers, twice the size of the population of the United States. China is Apple's biggest market outside the U.S., but many wonder if its new partnership will be enough to fend off stiffer competition from cheaper smartphone rivals and maintain its iconic status here long term.
The bottom line is it's going to help Apple to sell more phones in China. It's at a time when Apple's actually started to lose some of its allure, globally, in terms of their ability to sell a lot of phones. So there's no doubt it's good for them.
For now, these customers are happy to get a 5S or 5C. Just as investors will have to wait to see if this new marriage will pay off. For Nightly Business Report, I'm Eunice Yoon in Beijing.
General Electric's quarterly earnings were right on target, but investors weren't impressed, and that's where we begin tonight's market focus. Fourth quarter income was up nearly 5% as industrial revenue increased at GE, but the company has been able to grow profits by cutting costs and increasing productivity. But profit margins came in below forecast. Shares fell more than 2% to $26.58. Legal bills weighed on Morgan Stanley's profit, but investors didn't seem to mind. Legal expenses related to mortgage-backed securities topped $1 billion, but the firm said strong investment banking performance helped give a big lift to earnings. Shares rose more than 4% to $33.40.
Capital One's profit missed street estimates. That's because net interest fell in both the company's credit card and consumer banking franchises. Revenue slightly above consensus. Still, shares fell more than 5%, finishing the day at $72.39. IBM will invest more than $1 billion to expand its cloud services operation. The cloud expansion will include building 15 new data centers around the world. This isn't the company's first cloud investment. It acquired SoftLayer, a cloud computing business, last year for $2 billion. We'll see how these investments are paying off when the company reports its earnings on Tuesday. Shares rose today slightly to $190.09.
Well, many airlines will also be reporting their fourth quarter results next week, and profits are expected to be among the best the industry has ever reported. Phil LeBeau has more.
After years of struggling with soaring jet fuel prices, costly labor contracts, and the inability to bring in more revenue, the airline industry is finally soaring.
By and large, the airlines are indeed finally getting it down to where they're operating as a business rather than as a market share entity.
What lifted the airlines in the fourth quarter? For starters, they filled a higher percentage of their seats. United's a good example. Its load factor last month jumped 3%. At the same time, airlines have been gradually adding capacity, allowing them to sell more seats while not diluting airfares. Couple that with the airlines continuing to bring in more ancillary revenue from fees for checked bags or services like boarding early, and you have airlines bringing in more passenger revenue.
The airlines generally lose money or break even on actual ticket sales, where they're making all of their money, all of their profits right now, largely comes from these fees.
Finally, the fact that jet fuel prices have stayed in check means airline costs have done the same thing. Put it all together and you see why airline stocks have climbed to multi-year and in some cases record highs. Delta is the first carrier to report earnings next week with a profit that is expected to be substantial. And that's just the beginning. Later in the week, we'll hear from United, Alaska, and Southwest Airlines. Phil LeBeau, Nightly Business Report, Chicago.
Our market monitor has something for everybody tonight, a classic blue chip, a value play, and a sexy tech stock. He's Larry Rosenthal, president of his own firm, Rosenthal Wealth Management. Larry, welcome. Good to have you with us. You know, our earlier guest said that stock market performance going forward is all going to depend on earnings. And so far, from where I sit, earnings don't look all that great. Do you think they are all that great? Do you think they justify prices at current levels?
Well, Tyler, when you take a look at first of all, thanks for having me this evening. And earnings is coming in just as we sort of thought they would. We keep a very close eye on earnings, and they're coming in a mixed bag, and that's exactly what we're going to get in a moderate growth economy. But when you take a look at the earnings yield on the S&P, it's a little north of 6.5%, and you put that over top of a 10-year Treasury at 2.84%. We have a risk premium there of about 3.75, 3.8%, which is very attractive given the alternatives to the marketplace.
You were telling us earlier today that you like these normal kind of earnings season rather than shock and awe, you know, when they're really hot earnings. Tell us why.
Absolutely, Susie. You know, when earnings come in and they're shock and awe either to the miss or exceed expectations, the markets kind of get a little bit jittery like that, and we like to see a more normal earnings type of a season where we're coming in with a mixed bag. And again, that's to our expectation right now in a moderate growth type of an economy.
One other quick follow-up on earnings. I mean, you said that they're kind of consistent with a choppy economy, a slow-growing economy, but stock prices have been anything but over the past year indicative of a slow-growing, choppy economy. They've been going up 30%. How do you square the two very quickly?
Well, when you take a look at the backdrop of monetary policy, you know, the market's going to continue to punish savers and reward risk takers, and that's to my point of the 10-year hovering about 8.5 or 2.5 to 2.8%, with the earnings yield of 6.5 in the marketplace. That's what we're starting to see, and the market's still carrying a PE of in the 15 range, which really isn't that lofty right now. We think the S&P can get up to 1900, 1950, before we start to see some lofty range, if not even higher than that.
Okay, our viewers are going to be very curious about your stock recommendations in this market. Let's start with the first one, Dow Chemical. You say this is a classic blue chip.
Absolutely it is, Susie. Let's take a look at estimates on GDP in 2014 of about 2.5%. Well, the earnings growth estimate in Dow is 3.8. So here we have a company that's estimated to earn more than GDP in the U.S. And then you take a look again at the 10-year Treasury at 2.84 today. The yield on Dow is 3.3%. So we're getting paid more than the 10-year Treasury. It has a PE in the low 15s with an earnings yield on it of over 6.5. But the true underlying value of Dow Chemical here is, it delivers its products and services are plastics and chemicals. And Dow's major cost component is the use of natural gas. And with sort of the renaissance or the new natural gas explosion here in the U.S., Dow is going to be able to widen its margins substantially and deliver its products and services on a worldwide stage. We think Dow at this price is a very attractive buy for a long time.
We've only got about 60 seconds left, so I'm going to ask you to cover your next two, the value play Sinopec and the tech stock 3D Systems, in about 30 seconds each.
Let's see if we can handle that. Okay, Sinopec, great deep value buy, sort of a Warren Buffett-ish type of a long-term buy and hold. It delivers oil to mainland China, and one of the beautiful things about it right now is that we know that the rising middle class in the Asian region over there are going to use energy to consume. As GDP continues to go, it correlates very well.
And 3D Systems?
3D Systems is a great technology story. It's on the cutting edge. It's helping deliver products and services to the marketplace much faster through its 3D printing. The numbers are off the chart right now. It needs to increase its revenue. But if you like technology and want to be on the cutting edge, find a good entry point, put some limits underneath of it, and enjoy the ride with this.
Do you own any of these guys personally, or does your firm invest in them?
Yes, the firm owns Sinopec and 3D Systems. I personally own 3D Systems and Dow.
All right, Larry, thanks very much. Have a great weekend.
Thanks for having us. You
Larry
too.
Rosenthal
Bye-bye.
of Rosenthal Wealth Management in the Capitol tonight.
And coming up on the program, 20 years ago today, a massive earthquake shook Los Angeles. Lives were lost, homes were destroyed. So why do fewer people have quake insurance today than they did back then? That's next.
It's official, California is now in a state of emergency over the severe drought hitting that state. As we reported yesterday, the entire state is experiencing the worst dry spell in more than a century, and there is no rain in the forecast. This comes as firefighters battle wildfires and fierce winds in the Los Angeles area that have forced thousands of residents from their homes.
As if Californians don't have enough to worry about, there's also the ever-present threat of earthquakes. 20 years ago today, the Northridge quake struck, killing 57 and causing tens of billions of dollars in damages. Still, most Californians don't have earthquake insurance. So what can be done about it? Jane Wells has more.
Hello, is anybody there?
2 off in the morning of January 17th, 1994, there was no reply. The 6.7 earthquake crushed Los Angeles. 57 people died. Over 40,000 homes and buildings were damaged or destroyed. The economic impact totaled $49 billion, a record at the time.
The first pile you come to is where they're at.
Back then, many people walked away from their houses as total losses and home prices plummeted. Only 40% of Californians had expensive earthquake insurance. 20 years later, quake insurance costs even more, and fewer people have it.
It's stunning for a lot of people to realize that 90% of the homes out here in California have absolutely no protection for earthquake.
We were sitting in the living room and suddenly everything started shaking.
The state believes fewer than 1 million of California's 38 million residents has quake insurance. The Insurance Information Network of California said insurers paid out $15 billion in claims from the Northridge quake. or $24 billion in today's dollars. That figure exceeded all earthquake insurance premiums going back 30 years, and many companies stopped writing policies in California. Now, some homeowners believe federal taxpayers will bail them out in a disaster.
Government assistance falls short of that. It doesn't rebuild a home.
Then there's the problem of privately owned commercial buildings. No law has been passed in Los Angeles forcing landlords to make expensive upgrades. And while new construction has to meet new standards, it's all a matter of location, location, location. Hundreds of millions of dollars of new construction in Hollywood is going up on top of 2 newly discovered fault lines. Developers say geologists have detected no active quake activity, but opponents disagree.
This is an arrow in the heart of the most ill-conceived, dangerous, and reckless project in recent memory in the city of Los Angeles.
The anniversary has spurred the state to spend more to map the cracks and crevices under California's surface. After all, before 1994, no one knew about the fault that rocked Northridge.
And the people of LA should be cautious because earthquakes are just around the corner.
It's never a question of if, but when. For Nightly Business Report, Jane Wells, Northridge.
And that is Nightly Business Report for tonight. I'm Susie Garrow. Thanks for watching.
And thanks from me as well. I'm Tyler Matheson. Have a great long weekend, everybody. We'll see you here on Monday.
Nightly Business Report has been brought to you in part by...
Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus service is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Susie Garrow with a Nightly Business Report news brief. The first official week of earnings season is over, and it's been disappointing. The message from companies like General Electric, Intel, and UPS was lower revenues and weak outlooks. Only 8 of 30 Dow stocks ended higher today, all of them among the costliest ones in the price-weighted index, enough to push the Dow higher today and for the week. Those blue-chip Dow stocks gained 41 points, but the Nasdaq was down by 21, and the S&P lost 7 points. One day after reporting an earnings miss and a lukewarm forecast, chipmaker Intel is cutting more than 5,000 jobs. And a cybersecurity firm says 6 other U.S. retailers have been infected with the same type of malware used to breach Target's customers. Be sure to tune into Nightly Business Report right here on your public television station.